The core theme across the semiconductor and AI infrastructure landscape continues to center on capacity, not demand. Recent channel and supply chain checks indicate that server CPU demand is being pulled forward aggressively as AI infrastructure spending accelerates. According to those checks, both AMD and Intel are now close to being largely sold out of their expected 2026 data center CPU capacity. This is notable because it aligns with commentary heard during Intel's most recent earnings update, where management discussed actively shifting its supply chain to allocate more inventory toward data center CPUs due to tightening capacity. In that context, the checks act as a reinforcement rather than a contradiction. The implication of sold-out capacity is not necessarily that prices will rise automatically, but it does introduce optionality for vendors. In theory, constrained supply gives CPU providers greater leverage, either through pricing or through limiting sales concessions. That said, pricing outcomes remain highly dependent on customer contracts, particularly with hyperscalers that negotiate large volume agreements at fixed terms. Capacity tightness alone does not guarantee higher realized pricing, but it does change the negotiating dynamics. On Intel's side, the same analysis suggests that average selling prices for server CPUs could continue to trend higher if capacity remains constrained. More strategically, recent updates have increased confidence around Intel's 18A process progress. The view expressed is that Intel's foundry roadmap is becoming more credible, with the potential for Intel to emerge as the number 2 foundry supplier in the longer term. Alongside this, there has been industry chatter around possible interest from a major customer in Intel's foundry business. Reports have circulated suggesting Apple could utilize Intel foundry capacity for lower-end chips beginning around 2027. While those reports remain speculative, what is more firmly established is that 18A is progressing well. That progress has been reinforced by the announcement of Panther Lake at CES and indications that 14A development is also moving in the right direction. Turning to AMD, the CPU market remains a central pillar of the story. Expectations call for at least 50% growth in AMD's server CPU revenue. However, the more significant driver of enthusiasm is AMD's AI GPU accelerator business. Estimates point to $14 to $15 billion in AI GPU revenue this year, driven primarily by the MI355 and MI450 product lines, which are expected to be deployed within the AMD Helios rack platform. On the back of these assumptions, a price target of $270 has been assigned to AMD, well above current consensus levels. While price targets themselves are not the focal point here, the underlying supply chain checks and industry data carry greater weight. These checks provide visibility that is difficult to obtain from public disclosures alone. Importantly, AMD's own commentary aligns closely with this external analysis. During its Financial Analyst Day in December, AMD highlighted that AI adoption is directly driving incremental server CPU consumption. The company outlined expectations that AI workloads could generate an additional $30 billion of CPU demand by 2030, with growth continuing through 2025 and accelerating into 2026. That framework mirrors the conclusions being drawn from independent channel data. With that backdrop in mind, attention turns to Supermicro Computer. The stock recently declined by roughly 5%, bringing its market capitalization to approximately $16 to $17 billion. From a valuation perspective, Supermicro is beginning to screen as inexpensive. The company has guided toward approximately $35 to $36 billion in revenue for 2026, implying a forward price-to-sales ratio near 0.5. On a purely quantitative basis, that valuation appears compressed. However, valuation alone does not tell the full story. The core challenge facing Supermicro is margin erosion. Gross profit margins have deteriorated materially over the past several years. In December 2022, gross margins stood at 18.7%. In the most recent quarter, they had declined to approximately 9.3%, representing a reduction of more than 50%. In practical terms, this means the company must now generate roughly twice the revenue to produce the same amount of gross profit it earned less than 3 years ago. Operating margins have declined even more sharply. This level of margin compression represents a fundamental deterioration in business quality, not a short-term fluctuation. Competitive dynamics in the AI server market have played a meaningful role in this trend. As companies like NVIDIA increasingly standardize server designs and provide detailed blueprints, particularly around liquid-cooled architectures, barriers to entry have fallen. Innovations that once differentiated Supermicro, such as liquid cooling expertise, are now more broadly accessible across the industry. As competitors are able to bring comparable products to market more quickly, pricing pressure intensifies and margins continue to compress. These concerns were reinforced when Goldman Sachs initiated coverage on Supermicro with a sell rating and a 12-month price target of $26. That initiation was the primary catalyst for the stock's recent decline. The central argument was not that Supermicro lacks relevance in AI servers, but that the profit profile is unlikely to improve meaningfully in the near term. The persistent decline in both gross and operating margins over the past 3 years underscores that concern. While initiatives such as Supermicro's data center building blocks could eventually support higher margin revenue, near-term growth in those areas is not yet evident. As a result, Supermicro finds itself competing aggressively for market share in a crowded and rapidly evolving market. That competition inherently involves pricing pressure, which further constrains margins. While the valuation may appear attractive relative to forward revenue expectations, the underlying margin trajectory remains a significant risk factor that cannot be ignored. Finally, Meta Platforms warrants attention within the broader market context. Meta shares have declined from the mid-660s to the low 630s over the past several days, after peaking in the 670s roughly a month ago. The stock previously traded as high as the 790 range. Buying activity has been concentrated in the high 500s to low 600s range, and from a valuation standpoint, Meta stands out relative to other large-cap technology names. Alongside NVIDIA and Amazon, Meta is among the few large technology stocks that appear attractive on an individual basis, rather than solely through ETFs. Meta recently announced the Meta Compute Initiative, a new top-level effort focused on AI infrastructure. The company plans to build tens of gigawatts of capacity this decade, scaling to hundreds of gigawatts over time. The initiative formalizes Meta's approach to engineering, investment, partnerships, and long-term infrastructure planning. Leadership responsibilities have been clearly delineated, with technical architecture, silicon, software, and data center operations on one side, and long-term capacity strategy, supplier partnerships, and business modeling on the other. This effort will also involve coordination with government entities and sovereign AI initiatives. Importantly, this announcement should not be interpreted as Meta entering the commercial cloud business. Advertising revenue continues to grow steadily, and Meta has repeatedly stated that it remains compute-constrained within its core operations. Historically, the company has described itself as operating in a compute-starved state, even after substantial infrastructure investment. In that context, selling excess compute capacity would imply that Meta no longer needs that infrastructure internally, which would raise broader questions about AI demand sustainability. There is no indication that this is the case. Instead, the complexity of building large-scale AI data centers has increased materially. Power constraints, real estate limitations, regulatory hurdles, and government engagement now require dedicated organizational focus. The Meta Compute Initiative appears designed to address these structural challenges, rather than to commercialize excess capacity. Meta's strategy remains centered on supporting its core advertising and application ecosystem, where incremental compute investment has consistently unlocked